I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market came into the new year with quite a tone change. As the new year began, investors, they cheered this news that came out over the weekend on a massive report on Tesla's deliveries. They blew away even the best estimates, and that brought a lot of buyers in on Sunday night, Monday morning, but that rise turned into a giant hook as the market turned down sharply later in the week. Let's just quickly take a look at that news about Tesla and what it really means. This slide was shared by wolfstreet.com, and a friend of mine, member Greg W., put it up on Twitter, and I had to grab it because this is just amazing. If you look at this chart, you can see that on the left is total deliveries, and Tesla is way, way down over here on total deliveries compared to all the global automakers that you can see right over here. So their total market share is minuscule when you look at that compared to the rest of the automakers. But now when you compare the market caps of all these giant automakers right over here compared to Tesla, well, you could see Tesla has a market cap the same as all of these Honda, Stellantis, Ford, BMW, GM, Daimler, Volkswagen, Toyota. Amazing. Tesla is way up here with about $1 trillion market cap, maybe a little less right now, and it matches all of that. This is incredible. This shows you the massive overpricing and the way that the investors may really be hooked into something that, well, they've gotten paid now, that's for sure. But looking into the future with the massive competition that's coming into this this EV market, you gotta see some of these things coming out from Mercedes and Cadillac and GM and Volkswagen. They just are mind-blowing. And if the competition has not been able to keep up with Tesla before, well, they sure look like they're going to run over it right now. This is amazing when you look at that. Thanks for sharing that, Greg. I really appreciate that. So the new year often brings a lot of institutional maneuvering, position swapping into stocks that they believe will bring them alpha as they come into this year. And this year is extreme. Big selling, mega caps, techs, and the recovery stocks, the old industrials and the energies, even banks, getting a ton of money pouring into them. So there's giant swapping that's going on. And this has brought this huge disparity in the market. And one day this week had the Dow up well over 200 points while the NASDAQ was down over 200 points. And that's pretty rare stuff. Exacerbating this disparity was the FOMC minutes, which came out on Wednesday, and it was a shocker. It seems even that they were more hawkish than anybody had expected, and more hawkish than in 2018 when we had that big taper tantrum. In fact, it's the triple whammy, is that they're talking about faster interest rate increase, a faster taper of their buying and of the of securities, and that could end well before March, and actually a reduction of their balance sheet, which is QT, which quantitative tightening is not something that investors thought that they would hear out of the Fed. But this Fed has himself in a huge problem. They've hooked investors into thinking that it was stimulus forever, that fairy dust would be around and keep rising stocks. The only thing is that after all of these years, 3 massive years of gains for the stock market, now the Fed is hitting the brakes hard. And they've caused this big inflation that we have and all of these distortions that are going on. And now they want to act in a way to restore their credibility. And they talk about normalization. Well, when you look at the employment report this week, unemployment down to 3.9%. I mean, that is full employment. A lot of people leaving the workforce, and a lot of seniors that are retiring early. And of course, the government has made it easier for them to do that. And wage inflation is much hotter than they hoped for. So if the Fed is not going to do something now to restore their credibility and to do what they said they would do, that they have the tools to deal with inflation, then when will they do it? Well, if they don't do it now, it's never. So a lot of people say, well, the Fed will back off. They're not really going to do this. There's no way the market ticks down, and they'll back off of this. Well, I'm telling you, they got a plan, and they're not backing off at all. And the markets are reacting to that. Higher interest rates often affect the tax a lot, and they even affect the lower cap stocks a lot, because those are zombie companies and they don't make money. A lot of them are losing companies. But it does really affect techs and NASDAQ type stocks. And 40% of the NASDAQ stocks right now are down 50% or more. That is an amazing number. Here we are at all-time highs in the stock market, and 40% of NASDAQ stocks are down 50% or more from their 52-week highs. That is an incredible statement to make. So a lot of investors, they've already had their investments crushed. But of course, the index is held up by those 5 or 6 stocks in the indexes that are heavyweights, and that's over, I believe. And that's going to put big downside pressure on the indexes. I said that a few weeks ago, and I'm saying it now. And that we're likely to see that rotation, and it's going to remain. You're going to see high caps, which are a huge source of funds, moving down as investors pull money out of those and look for these recovery stocks, the stocks that are of better value and that will benefit from the end of the pandemic. They're going to be moving into that. And this should be a great time for traders with big swings. And keep in mind, it's going to make sense to buy the strong and sell the weak. And if you just listen to that statement, buy strong and sell weak, that's going to save you a lot of money and maybe make you some. Well, for the stock market, did you watch the recent big picture analysis that I did on the stock market? We published that. It's out on YouTube now. And I encourage you to watch that. I discussed a 100-year chart with a 7-year cycle that had the market in a declining mode in 22 and maybe even into early 23. Interestingly, I had several emails telling me that this matched the Shemitah cycle. I looked it up. I'd heard about it before. I wasn't sure what it was. And pretty remarkable. It aligns with our work really, really well. And the Hebrew word Shemitah means release. It follows that the 7-day cycle, where the 7th day is the day of rest, the Sabbath. And this is the 7th year, the year of rest. And many, many things happened in that 7th year if you look up some of the information on the Shemitah cycle, that were brought some pretty bad downsides and pretty negative events. So amazing how it lines up. Yes, we are looking for 22 and 20 and maybe into 23 to be a rough time. For the last several weeks, and several months actually, I've been using the language raise cash. You can see that the market now is disrupted, that's for sure, and it's likely to be choppy, and you're going to get two-sided movement in here. And I really think that of these rallies that we might see, and we will see, are opportunities, and the opportunities for you to raise cash. While many stocks had huge declines, the indexes are still near their highs. I'm going to make the risk reward right now at 15-1 to the downside. How do you like that? So 1% up versus 15% down, maybe 2% up versus 30% down. Remember, bear markets, which happen regularly, in fact, about an average of close to every 7 years, well, they average over 30% declines. And I've traded them since 1974. So I've traded all the bear markets, all the crashes, all of those since 1974. And I can tell you, they get to be ugly. I'll say it again. 2022 is likely to be a bear market year. And the Fed will help with that, as you can see, help with that drop. For the week, the S&P 500 and the Russell, well, S&P down a little less than 2%, the Russell down a little more than 2%, the NASDAQ down over 6%, just those stocks getting hammered. The Dow, about even, maybe a tiny little fraction to the downside here at midday on Friday, as many of those recovery stocks, growth stocks, they're in that Dow. You can see Caterpillar moving up pretty sharply, and like I said, buy the strong, sell the weak. Bond market, it plunged, absolutely cratered. And we did a special a couple of weeks ago that said we talked about the coming interest rate spike. And I'm going to review that in just a couple of minutes. 30 years down over 4 points. It's a crusher. The 10-year yields up 28 basis points to about 1.8%. That gets very close to hitting our first upside target. I'll show you the other targets that we're looking at in just a few minutes. Gold market down about $39 on the week as interest rates do affect the metals in a negative way. When interest rates go up, well, there's not as much money, or money is too expensive, or it causes the dollar to go up and the metals, they move down. So gold moved into our resistance zone, which we said was between 1820 and 1840. And then fell sharply. Silver did the same, moved into its resistance zone and falls over $1.10 on the week. And the Bitcoin market, well, it's in big trouble. It broke key supports. We warned about that. It's down about $4,500 on the week. It's down over $10,000 in 2 weeks from that recovery peak. And all those people out there that are living in the fantasy that Bitcoin and cryptocurrencies are something that is real, well, they very well this year may find out something very different. Actually, we're looking for Bitcoin to potentially be under 20,000 this year. Dollar, slight gains on the week because there's a little bit of a safety bid going in, and of course higher rates help the dollar. And the oil market explodes up for the third week now, up about $3.50 on the week on this Euro crisis for energy, certainly helping it. And it hit our upper resistance zone about $80.50. And if it gets through there, it's really in a different picture than we thought. A close over about $80.60 is going to be a pretty positive occurrence. We'd look for a pullback, but then much higher prices. Right now, we're projecting it to get under $74, though, in a pullback, but a much improved situation for the energy market. Coming up, we're going to be looking at a preview. RV is going to preview a new segment for our members that is just fantastic, where he looks at how to look at favorable setups for short-term swing trades. He looks at 12 different stocks, but he's going to only preview one with you here, and the rest is for our members. So you'll have to become a member, level 2, 3, or 4, to watch that video. I'm going to do a review on this interest rate analysis. And then don't go away, because there's an amazing special, which we are starting this week, with some very enhanced content that you're going to be able to get a massive amount of our content. Massive. All of our videos, live, tons of live content for $29.50 for a month. $29.50. So make sure you watch that special. And I'm going to do a stock market preview coming up, where we're going to look at the S&P 500, SPY, and the QQQ. And I'm going to compare a little bit in there about what's going on for them. So really tons of stuff coming up. So don't go away. Make sure you watch that special. Please do go to our website and explore or look around there. You become a free member, or you can take advantage of this great special that's coming up. that I'll show you, so make sure you watch it. If you're on YouTube, please do subscribe to our channel, click that notification bell, and like our videos. Give it a thumbs up, that does help us, and follow me on Twitter at askSlim. Questions on our membership for the info on any of the new stuff I'm going to show you, and questions on all of our huge offerings of education and analysis, you can write to Matt at askSlim.com. All right, coming up is our great analyst, Arvi, one of the experts in the world in cycle analysis, and he is going to show you our new stock sectors variation on there, a new segment where he looks at short-term swing trade planning and showing you how to find setups with quality entries in all of the stocks and the universe that you look at. So he's going to show you this. This is a preview. You're going to see one stock, but there's a dozen stocks that he does do analysis on if you become a level 2 member. So that is coming up right now.
So this is Google, and you can see this beautiful uptrend that we've been in with positive cycles after positive cycles, higher cycle highs, higher cycle lows. So really no reason to be bearish on this on the intermediate term as of yet. And so far we do not have a lower low. But what we're seeing here is a high that has likely already formed here in Google, as we had this rising phase here, the high that formed right there. And then we are now rolling over in this corrective period. The next key low is due 214 to 328, and you can see we have negative weekly momentum here as well. What we're looking for in Google is for, at the very least on the intermediate term, is for a move through that key weekly cycle low at 2621. If we go ahead and shift to the daily, you can see what we're looking at on the daily, and just as an FYI, we do have a short side trade idea out in Google currently. For Google, we have a dominant daily, which is broken up into minor thirds. And what I want to highlight are these minor thirds. So you can see we got the rising phase here, then we had the pullback here from the first minor cycle low, then the rally off that minor cycle low, the pullback into the next minor cycle low, then the rally, and then the sharp failure as we had the dominant cycle pushing down as well as the minor. That's a period of heightened risk, and you can see the sharp failure. Here we have the rally with 2 cycles pushing up, got a failure, and actually broke that daily low as we formed that next key minor low, then moved all the way back in that rising phase to look at that 78.6. That is somewhat unusual, but you can see we didn't get any closes over that level and then backed off and then moved into that next minor low right there. So what's going on now is we are just getting into the rising phase on this minor cycle. Now, given that this dominant cycle is now pushing down, since we have now broken that key daily low, we will look for this zone here to hold it on the upside from right around 28.27 or so to 28.86. Look for that zone to hold it, and then for this to rotate back on the downside one more time to complete this dominant daily cycle here. That's really what we're looking for in Google. The next key low is due 118 to 127, and Google really needs to hold below this 78.6 at 29.25 to keep this overall pattern on the downside valid. So that's really the overall picture in Google, a bearish look, and that's really why we have a short side bias here.
All right, I'm going to do a review on 10-year yields. We're going to look at the TNX weekly and daily. That is the 10-year yield. It was just a few weeks ago where I talked about the coming interest rate spike. And you see it happening right now. Very significant that the bond market collapsed right on time. And we had talked about the bond market moving down into late February or March in a big way and pushing yields up. That's actually happening. I want to do a quick review looking at those charts so that you can get an idea of where we are now as we look only at the TNX, the 10-year yields, and I'll explain the cycle analysis to you just as Arvi did in the previous segment, and I think you're going to find it fascinating. So this is TNX. This is the 10-year yields. And what we're looking at here is a side-by-side chart where we're looking at the weekly right over here, 10-year weekly and 2-year daily. And what you see in the bottom here, if you're not familiar with our work, these are cycle brackets. And what they do is show you the ideal rhythms, assuming that each of the cycle rhythms has a consistent distance in each of those. A cycle is measured from low to low or trough to trough. And this is the ideal right there. Now, what you're looking at up here is the actual, how the ideal turned into the actual. And you can see that the cycle rhythms that show up on the bottom show up here also on the top. Let's blow this up so that you can see where we are right now. So this is the weekly chart. As I said, here you could see a base formed after the big drop in yields during the pandemic. A base is when you get a higher bottom, as you can see in this perfect rhythm right there. The next cycle, this upward green arrow, shows you that this was a very positive cycle. What this line is right over here is our reversal scout. This is a real good momentum indicator and also helps us understand the cyclic movements that we see in here. So you can see that it turned positive right in here at the bottom of this cycle and continued to move up. And in this modest correction right over here, it wasn't even able to turn down. Here is where the reversal scout turned down, gave you the warning that this cycle and the minor one right in here were both going to be moving to the downside in yields, and that's what you saw. So downside in yields meant a rally in futures. Here is a rally in yields, as you can see, and a cycle that is again configured bullishly. In other words, the low is way down here, the low is right over here. It says that the next rally is likely to move up and take out that high. Well, look what happened right over here this week as we had this 28 basis point jump. So where are we right now? Well, these are this is the projection on this next cycle that we're in. I want you to note that we are now about 2 weeks or maybe 3 weeks into this rising phase of the dominant and the minor cycle. That says interest rates are very likely to be rising into this March period. That's this minor cycle here, and then maybe again out over here way into that May-June period. So this is the beginning of this spike that we were looking for, and it came out perfectly. These are the fib extension targets. So our first target was right over here, just over 1.8%. Today we got up to a high of 1.8%. So we came up and tagged the bottom of that first projection. But it's so early, the odds are pretty high it's going to follow this track right over here or the higher track right there. So that puts the high at about 1.93 up to about 2.9, right there, 2.8 in these next number of weeks. That is a lot of upward interest rate pressure that's likely to go on, and that is suggestive of that if you get rally days in the bond market or pullbacks in yield, that you should be shorting the bond market because yields are likely to go up for some extended period of time. And of course, we can see right now the stock market hates it when the bond market goes down and yields go up and investors sell very hard. And if we have all of this period of rising interest rates, the stock market's in a world of hurt. Take a look here at the daily chart. This daily chart has got two what we call out-of-phase cycles in here, a minor one and a larger one right in here. And you could see where they both nested. They got close together to their troughs right over here. It brought the big rally. We have another nesting period right over here. This time frame in here is around the 3rd to the 4th week of January. So what that says to us is that if we looked at the weekly chart and it says to us that, well, the yields are likely to go up well up into March, that this time frame in here is a time frame where over the next couple of weeks you could get a pullback in yields or a temporary bounce in the futures market. However, if it pulled back here to that area of these minor supports right there that you see, that's around under 1.69 to about 1.65 or so. This is 1.62. If you get that kind of pullback in yields and rally in the bond market, you can see right there we say sell futures in that area because, of course, we say that the yields are likely to be moving up again when you get out of this nested area in these next cycles. So that says a pullback in here is going to be a selling opportunity in futures, and also this is probably going to bring a bounce or a rally in the stock market. The S&Ps could still test the highs, I suppose, but that is going to be also an opportunity to sell stocks, in my opinion. So that's the update on this review here in the yield market, which simply, bottom line, says yields are very likely to be spiking on the upside still for maybe a couple of more months, and that is going to put pressure on the stock market. That's really what it looks like. So I hope that was valuable to you for sure. All right, coming up, we're going to do our analysis on the stock market. But first, you got to watch this. This is incredible. This is our new level 2 trial. For new subs, a 50% discount. What are you going to get? You're going to get our stock index report live stream. So that is those are live charts, and I'm going to show you examples of a bunch of these, of the S&P 500, the NASDAQ, intraday. You don't need any special platform. You'll be able to put that up right on your computer. You're going to get our stock index report, our enhanced daily snapshot on the indexes every single day. Matt puts that out. Incredible amount of information, the important levels, the conditions of the market. You're going to get our chart streams live. Now, this is now added for level 2 members, where you'll be able to see our multiple time frame charts with our proprietary studies on the S&P 500. We have 10 different live chart streams, but we're going to move the S&P down to level 2 from level 3 for the benefit of our level 2 subscribers, since most of you are looking at short-term trading in the S&P 500 and the indexes. This will be great for you. You're going to get our stock index weekly ETF review, our Slimulator Momentum Tracker, which over 1,000 stocks gives you the conditions for longer-term perspectives. You're going to have our whole video library, over 600 videos in 9 categories. I'll show you that in a moment. And our new trader workbench. There's a new amazing tool in there. It's our focus list on a worksheet, which then gives you the opportunity to see our live charts and to see when these cycle patterns are bottoming and when you can expect a favorable condition on these focus list 84 different symbols. So absolutely fantastic. Tons of information. All that, 50% discount, $29.50 for the first month. That's versus $59. You don't like it, cancel. You won't renew then. And you want to sign up, just go to the top of the askSlim main page. There's a link there, and you're going to get all of that. Let me give you an example. This is our SIR live stream, short-term index trading, S&P 500, NASDAQ, and the Russell. This was a couple days ago when the market turned down very sharply. You could see the reversal scout right in here on the S&P 500, on the NASDAQ, and on the Russell. They moved very much together. Many days they don't, and you get a lot of information about what's strong and what's weak. These yellow zones are called acceleration zones. If they get into them, the odds are better than 80% they're going to move through them. And you could see this move 3 of them right there. So in other words, you'd have gotten on the short side and you've been able to take the ride on the downside, which was a huge, huge move. And we put in all the resistance levels, all the support levels, and you have all this great information live all of the time by putting up the SIR live stream. That's included with the new level 2. Now you'll be able to see so much more. You look at this. This is our chart streams live, multiple time frame chart. It's weekly, daily, 2-hour, 15-minute with our proprietary indicators on there. And it's live. You'll be able to view our proprietary indicators, and you'll be able to see the conditions really at a glance. We like to say that we know the market condition at a glance because we can see the weekly momentum condition here, the daily with our proprietary studies, the 2-hour with those studies, and the 15 minutes. You see when the 2-hour turns negative over here and the 15-minute turn negative, if you're a short-term trader, well, that's when the biggest impulses are on the downside. You could see how well that worked. This will be live with no special platform, running right on the askSlim platform. I said we have a new enhanced workbench. Our worksheets now include our charts. So what you do is you'll be able to click on the little button right over there for the weekly and the daily chart, as you can see, and then it'll pop up for you to see the chart in all of our focus list. That's for the focus list right over here. And then you will be able to also see when the cycle lows are due. So in other words, when a cycle low is due, that's when a stock or a symbol declines into that time frame. And when there's a synchronicity in the matching in the weekly and the daily, then you get a really important levels in there. So you're going to get our weekly cycle low, our daily cycle low. That is fantastic information to have. So all of this in this enhanced worksheet for level 2. And of course, you're going to get our massive video library. We put up 3 new ones each week. Future Speak, where I do 24 different futures contracts, 26 sometimes on Wednesdays, 52 charts in over an hour that I bring you our analysis in. Tools for Techs, over 80 different videos in there teaching you all about charting and charting tools and studies. Trader Psychology, over 25 videos in which I bring you, teachings on how to deal with personal issues that reduce profitability. You'll get our stock sectors analysis of ETFs and stocks and stuff that's ready to pop and drop. And a great one that Arvi did today in that category, talking about the swing trading and how to find those best entries. Big picture analysis, where we look at long-term perspective of the major markets, style, strategy, and play on many subjects and engaging in the markets. New guided visualizations. I put them in there right now. It's working through personal issues when you get triggered by the market and life. There are 5 of those for each of the core emotions right now. So if you get triggered, you want to go in there, and I'm going to help you through that. Market Week, our archive of past shows, and our askSlim Live, replays of our live events. You're going to get all of that in these over 600 videos that we have right now. And the level 2 trial, well, $29.50 for a month. It's versus a $59 regular. Just cancel, and you'll get all of this great information. Just cancel if you don't like it, and then if you don't and you stay with it, well, then you'll be paying $59 a month. We want to be honest about that. But for the first month, $29.50. This is an unbelievable way to get a perspective of all of this information that is certainly going to help you with your trading and investing. That's the askSlim Level 2 trial. I hope you find it just incredibly valuable. Go to the top of the main page. You'll see that little green link, and it says 50% off, and you'll be able to click on there. You have any problems, write Matt at askSlim.com for that info on it, or if you need him to send you a link, he'll be glad to do that. Level 2 trial, 50% discount. Sign up right now. All right, this is the stock market short-term view. So I'm going to compare SPY and QQQ, give you the cycle analysis for the short term. This is generally a 1 to 3 week perspective. Normally I bring the longer perspectives and not the shorter ones, but I wanted to bring this one and also show you the conditions of these indexes using a new askSlim Market Monitor, which is for our level 4 members. I'm going to show you just the Market Monitor for these indexes, and I think you're going to find it really fascinating. Bigger picture, we were looking for a top in the market early in this year, and then a very serious correction in several waves, with the first one down and through March, where we expected to see a significantly weaker market. Let's take a look now as we switch over and take a look. Well, this is the TNX on the analysis that I just did, but we're going to look at the SPY on the short-term chart. Let me just move into this short-term chart right over here. So this is SPY, and what we're looking at here are the cyclic harmonics, which are on the bottom. That more digger dominant cycle right in here aligns with the Russell, which has been really a tell in what the market conditions are. These shorter cycles, as you can see right in here, how they align up in the market right here. And this one right here, which bottomed, this one was a little short, as you could see, and then this one a little bit long. And this is where that bottom is due. So we expected selling to come in early in the year and then move to the downside. Now, you can see on the bottom is the slim ribbon PO. This is our signal indicator and our momentum indicator that's based off of the slim ribbon right over here. So the stock market, the S&P 500, has come down into this support right over here. And the expectation is that it's going to get a rebound in here for the next couple of weeks, potentially. If you get a rebound in here and take out this low, that's going to be a very bad signal. But conditions in here are still okay when you look at this. The slim ribbon's still positive, and you can see that by this being green. The slim ribbon turned positive right over here, and it gave you that week and a half of upside move into that holiday, and it has remained positive. So the momentum conditions are not really changing a lot looking at the S&P 500. Now get yourself a good mental picture of what this looks like. Again, we said that, it's getting into support. It didn't get anywhere near these last lows over here, and now is in an area where it could give you a rebound. Then you would get a rebound in the market if you got the rebound that we discussed in the bond market. If you didn't watch that review, go back and watch it in the full show. And we expect to get a bond market rebound of a minor consequence, and that could help this stock market move up and maybe even move up and test that high at about close to 480 in the SPY. All along, we talked about the likelihood of a divergent top where the other indexes wouldn't do as well. Now, look at this picture right over here. It's very different when we look at the QQQ. So this shows you that same cycle and cycle right in here. This broke down right in the middle. It got down right down to those lows, didn't quite close below it, then rallied up here, tested the highs, and came down back to this level again. So this is where some intermediate supports come in, but this is a negative occurrence when you get this type of a shape. I also want you to see while the S&P 500 has held in here and has stayed positive, look at the slim ribbon PO. This is now red, and there's a red arrow right over there which says to you momentum has broken down in the NASDAQ. And all you have to do is look at the tape to be able to see that that is true. So we have that momentum breakdown there in the NASDAQ. That says to us that when you get the expected rebound in here, that this is a sell. And that's going to align and give you a message with the whole market. While the S&P 500 may get up and test the highs, this zone is the best that we would expect the QQQ to do. That's 389 to up here about 394.5. The center line right over there about 392. So if we got up over here above that 388.5 area, that's where I would begin initiating shorts. We're going to expect this rebound to come right in here as we get into this rising phase. Note, rising phase, the rally, rising phase, but a deficient cycle right over here is this one made a lower low, this one equaled the lows, and you've got this kind of double top formation set up and this downward channel going on. And if you look at the bottom of the downward channel and look at the measurement, that's way down over here at about 343, which is a pretty reasonable target in March for us, depending on how this accelerates to the downside. So a very different picture. I'm going to go back and forth as you look at the SPY right in here, which has positive momentum conditions, the QQQ right in here, which has negative momentum conditions. Now, so I wanted to show you that and so that you could see the comparison and the fact that your guide is really going to be, well, can the S&P challenge those highs? How does the QQQ, the NASDAQ, do when it gets up into that resistance zone? And we don't really have the anchor point in here yet. We don't have a bottom made yet. So all of this could move into lower prices before we have that bottom set. I wanted to show you right in here looking at our askSlim market monitor right there, and I'm just going to enhance that for you a bit and show you that. This is the market monitor, and what this looks at is our proprietary indicators, our reversal scout, our slim ribbon, the market condition indicator, and the option bias indicator. So what we have in here, looking at the SPY, all of a sudden the reversal scout, which is measuring it on the shorter term pattern, is turning negative, so that's turning down. The slim ribbon is still positive, as I showed you. That's compared to the negative slim ribbon here in the QQQ. The MCI market condition indicator is low in the S&P 500 and the QQQ. When it's between 25 and minus 25, it's really in the area of the, that's why it's orange and not red, of just slightly negative. But look at the IWM, that's minus 68. It's neutral here. Reversal scout, you can see the mixed condition right over there. And the Dow Jones, clearly green, green, green all across, telling you the strongest conditions are there. So our option bias indicator, S&P 500, is still the highest level at 3.0. That tells you it's likely to give you the best rally, and these other ones right in here, the QQQ and IWM, are neutral. So you can see very clearly looking at this, the SPY is stronger than the QQQ, and the Dow is strongest of all. You can get this market monitor by becoming a level 4 member, and you will benefit from the amazing quality of that work. Again, what we're looking for in here is a rally to begin sometime in the next several days for the stock market. It's likely to be substandard. I have doubts about it making a new high in the S&P, but which should likely do better than the QQQ, than the NASDAQ. The NASDAQ hits that sell zone. I really think that's an important piece of information right there, how it acts at that level, and the conditions overall better for the SPY and certainly much better for the Dow than they are for the QQQ. Like I said in the beginning of the show, buy strong and sell weak. I think that's going to be extremely important going forward. That's it for this show. I hope you found it absolutely fascinating. I want to remind you, please go to the askSlim website and look around over there. If you're on YouTube, please do subscribe to this channel. Click that bell, the notification bell, and it'll let you know that when we put videos up. And like this video, give us a thumbs up. Watch a lot of our other member videos that we posted in there. And in the playlists in our past shows, you're going to find some of those extremely fascinating. Just put up another one in the trader psychology category that I think you will love. Twitter, follow us at askSlim. Any questions about everything I showed you on our memberships, write to Matt at askSlim.com. I think you will find it absolutely incredibly fascinating. Please do remember, I want you to be extremely careful. It is so crazy out there. And I'm always wishing you great trading.